Alright, now we're going to do a scenario analysis for our net present value model with Shrieves Casting Company. Recall that we have already created a model which generates the cash flows for this particular project. We've got some costs, we've got some salvage value, we've got some sales, a whole bunch of assumptions here. And we have a model which projects out cash flows, and if you go back and look at the Shrieves cash flow model, then it shows how to construct this model. And ultimately we have an NPV. Now in the last video what I did was I showed you how to do a sensitivity analysis for Shrieves Casting Company using data tables, and we created a graph that was a sensitivity analysis chart for this. And now what we're going to do is a scenario analysis. The problem with a sensitivity analysis is that it's not true that all of these different variables, all of these different changes are necessarily independent of each other. So what we analyzed in the sensitivity analysis is what happens if the discount rate is not what you thought it was going to be, or what happens if the unit sales is not right, or what happens if salvage value is not what you thought it was going to be. So instead it might be that you have a better example is instead we might have a recession over the next couple of years. We might have a great growth spurt over the next couple of years. Things might stay pretty much the same over the next couple of years, and each one of those scenarios looks very different. They have different combinations of discount rate and unit sales and salvage value. Well, to make this simple, what I've done is I'm going to just pick two of these variables to look at. Let's suppose there's a 25% probability of a really good scenario in which we sell 1,600 units rather than our base case assumption of 1,250. And we're going to sell each of those at $240 a piece. There's a 50% probability of our base case scenario, which was 1,250 units at $200 each, and there's a 25% probability of a really bad state of the world in which we sell only 900 units, and let's go ahead and make that a little bit bigger so that we can actually see that, and the selling price is $160 a unit. So we've got a really good scenario, the same scenario that we projected, and then a really poor scenario. Now, just for entertainment's sake, I'm going to show you how to do this because we only have two variables that we're changing. I'm going to show you a two-variable data table, and in general, you're probably not going to do a two-variable data table for something like this because usually in a scenario analysis you'll have more than two variables that you're changing, and so a two-variable data table is not going to really help you. But let's go ahead and do it because if you've never seen a two-variable data table, you ought to see. So, whoops, let's undo that. I'm just going to take the stuff out of the middle. So here's what we're going to do with a two-variable data table. We are going to vary the number of sales from 900 to 1250 to 1600. And we're going to vary the selling price from 240 down to 200 down to 160. Now the way a two-variable data table works is very much like a one-variable data table. However, instead of putting our NPV cell reference in the upper right-hand corner, we used to put it right there, in the upper right-hand corner, we put it in the upper left-hand corner of the data table because we got numbers over here in the right-hand in that row over there, which are the column headings. And so what we're going to do is have a cell reference pointing to the number that we want to evaluate, and we're going to tell Excel to plug in 240, 200, and 160 in for, let's get up here, unit price. And we're going to tell Excel to plug in 1,600, 1,250, and 900 for the numbers of units sold. And we're going to do that with a column input cell and a row input cell. So let's go ahead and highlight this. And we're going to do data. Over here is the what if analysis. So what if analysis, data table. Now we've got a two-dimensional data table. The data that's in the row, the 240, the 200, and the 160, is going to go right there for unit price. The data that's in the column, notice that's the 1600, 1250, and the 900, that's going to go in 1250 there. in cell B9. Click OK. And what the data table automatically does is it fills in the net present value for each one of those pairs of inputs. This yellow highlighted cell consists of the net present value when you have 240 units sold and 1,600 units sold and a price of 240. This cell over here, which is one we don't care about, is one in which you have $160 per unit is how much you sell it for, and you've sold 1,600 of them. But we cared only about those three ones along the diagonal. So in this case, we're just going to pick those off, and I just put in cell references here to those three along the diagonal because it's going to turn out to make my life a little bit easier and your life a little bit easier to have those there. All right, now if we want to calculate the expected net present value of this particular project under these scenarios, we've got three different possible outcomes with three different subjective probabilities. And how do we do this calculation? We want this 25% multiplied by the outcome with that really good outcome plus the 50% multiplied by this outcome, and then the worst outcome, 25% multiplied by this really crummy outcome. Well, the easy way to do this, let me delete this. The easy way to do this is to, I'll delete these two, is to use, well, we could just do the multiplication term by term, but the easiest way is to use the Excel function sum product, which takes one array, in this case all of those probabilities, and then multiplies it pairwise. All right, so C77 up to C79 by another array. In this case, it's those outcomes. And if you look at this, what's going to happen, I'll scroll back over here to the formula. And actually, let me go ahead and make it so that you can see this a little bit better. All right, this formula here takes C77 and multiplies it by I77, D77 and multiplies it, C78 and multiplies it by I78, and C79 and multiplies it by I79. That's probability times outcome, probability times outcome, probability times outcome, and that gives us an expected net present value of $101,000. Now, standard deviation can be calculated that way as well. Notice you cannot use the stdev function in Excel to do this because the stdev function assumes that all of the outcomes are equally likely, and it also assumes that you have you don't have the total population. It assumes you have a sample. So either way, you're going to get the wrong answer if you use the stdev function. Instead, you can either go through the long, complicated way of calculating the deviations from the mean. There's our expected NPV. Deviations from the expected value. So you could go and calculate the $278,000 minus the $101,000, square that deviation, multiply it by 25%, then do the same thing for the base case, and then for the worst case, add those all up and take the square root. That gives you the standard deviation, and that takes about 3 columns and 5 minutes to do in Excel. Alternately, and I'm going to talk you through this, you can use the sum product again. And so the way you do that is, we know we're going to do a square root. So we're going to take the square root of the variance. So we're going to get, we'll take a square root. Now we're going to use sum product. And, whoops, let me go ahead and make this so that you can see it all as I calculate it. So equal SQRT, sum product. Now, what are we going to have? Well, we want to do term by term. We want probabilities. So we're going to have 25% times a squared deviation from the mean. Now, how am I going to calculate a squared deviation from the mean? Well, what I want is a deviation from the mean and then another deviation from the mean, and I want to multiply those together. So how do I get a deviation from the mean? Well, okay. Here are the outcomes. So let's look at this. I77 to I79, those are the outcomes. And what I'd like is to subtract the expected value that we just calculated from those outcomes. And the way you can do this is this is really very clever, that I77 colon I79 and then minus the expected NPV, that gives you So this little section right here, this gives you a deviation, a row, or actually a column, an array that has three elements in it, and each element is a deviation from the mean. It's basically 278,940 minus that 101,000. It's 88,010 minus the 101,000, and it's the negative 48,528 minus the 101,000. That's what's very clever about this formula. And if we do that twice, it's going to basically square it. So we're going to do exactly the same thing that we just did a second ago. So we have I-77 colon I-79 minus B-81, and then we have it again because we're going to square those deviations from the mean. And put another parentheses, make sure you got the right number of parentheses, press enter, and we have the standard deviation, 116,000 bucks. That's correct. I'm going to double click on this one more time so that you can look at it and see what's going on. Those are the that's the I-77 to I-79. All right, coefficient of variation, that's just the standard deviation divided by the mean, or the expected value, and so it's 1.15. Now, this is 11 minutes, so we can do this really quickly here. The scenario manager is perhaps a better way of coming up with these outcomes when you have lots of variables that are changing. And to make life kind of easy for us, we're only changing two variables, right? We're changing the units sold, and we're changing the selling price, and we're looking at the NPV. Let's do this. I would like to, because in the scenario summary it'd be nice to have these things labeled rather than just have cell references. I'm going to call this NPV function, this NPV cell here, this is the one that has 88,000 bucks in it. I'm going to call that NPV because if you go up here into the upper left hand corner there, you can actually name it something. So now we've got NPV as the name of this cell. It's also cell B50, but it'll report NPV as the name of it. Similarly, we want to do the units sold, so we're going to call this units sold. Okay, except I can't have spaces in it, so units sold, and we're going to call this unit price, selling price. And so now what we'll do is let's do this scenario analysis. The way you do a scenario analysis, and here's a quick little description here. What you do is you go to the scenario manager, and we're going to tell Excel what needs to happen. So let's go on up there and do this. I'm going to scroll up a little bit higher because we're going to change these variables. All right, so data, what if analysis, scenario manager. Now I've already put these in here, so let me delete them, and we'll put them back in again. All right, so let's delete that one too. All right, so we're going to add one, and let's call this one the base case. And our base case scenario is going to consist of changing cells B10 and B11. We're going to change actually we're going to leave them at 1250 and 200, but we're going to change that's what's going to change. And they're going to be at 1250 and 200, and we'll say, okay, that's good. Units sold will be 1250, selling price will be 200, and notice it's now referring to those as the clever names that we came up with those. We'll click OK. Let's add another one. The good case, let's call it the good scenario, is again changing cells B9 to B10. We're going to change those to 1600 and 240. We're going to sell those for 240 each. Okay, and now we're going to add a bad scenario, which again is changing cells B9 and B10, and we're going to change that to 900 units and 160 bucks each. All right. Now, if you want to look at a certain scenario for your whole model, then you just view it. So for example, in this case, we're looking at the base case, and if I click the show button, it's going to show us exactly what we have. But if I click on the good case, notice that, and I'm going to go over here, see I'm pointing to it with the cursor, B9 and B10 are going to change if I hit show to 1600 and 240. And if we go on down here, we'll notice that the NPV has changed to the NPV for that really good case. Similarly, if we go back to what if analysis, scenario manager, if we look at the bad case, we'll be able to show that one, and notice our NPV changes to the really bad NPV there in B50. Now what we'd really like is a way to summarize all of this, and we can do that with something called the summary, Scenario Manager Summary. And so what we'd like to do is we would like to create a scenario summary, and the first thing that Excel wants to know is what value is it that you really want to know something about. In this case, we'd like to know something about the NPV, which is in cell B50. So that result cell is B50. Click OK, and it's going to ask us what do we want to do with this. We're going to create a new table. This is one that I did before. Let's delete that one. It's going to create a new table, and what it says is, well, for units sold of 900 and the selling price of 1600, let's make this look a little bit bigger so you can see it. 900 and selling price of 160, we have a NPV of negative 48,000. For the base case of 1250 and 200, we have the 88,000, the good case, and the bad case. So what we have is the base case, the good case, the bad case, and now we can use these three numbers here in calculating expected NPV and calculating the standard deviation, and we don't have to do it with a data table. If we had, instead of just only two variables changing, had 5 or 10, I think you can have as many as 32, then we could have very complicated scenarios and have outcome measures for each of those very complicated scenarios. Okay, so that's it.